Right, so tax calculation is a supporting calculation in the model, so it's below here, okay? And if you recall, we have the tax calculation geared and ungeared. I have a video on this, as I said before. Just watch the video on the project and equity returns, so you're going to understand what the difference is. But in a nutshell, the tax calculation, the geared tax calculation, is used whenever we have debt attached to our projects, and it's going to be used for the equity investor returns. And the ungeared tax calculation is essentially when you don't have any leverage, or your project is not geared, or there's unleverage, or sorry, there's no leverage to the project, and then you're calculating the returns only based on the project's cash flow, regardless of any sort of leverage you can do. And as someone who does valuations, that's a pretty important metric, right? Or as an investor, it's a pretty important metric because you want to see how good the project is based on its own merits without any sort of leverage. And that's one of the approaches that you can see, you can judge the project, right? And of course, later on, we're going to get your own financial capabilities and how cheap you can get that and how much you can leverage it, and you'll calculate only based on the money, on the equity that are going to come up with for the project. So that's basically the difference, okay? And as if we go up here, what we're going to calculate first is our equity returns. We're going to calculate the tax calculations with the debt or geared, okay? And what is the difference? Basically, only interest expense. Whenever you have debt, you can use the interest expense to reduce the tax to be paid. And because we don't have any debt in here, there is no interest to be deducted from your net income statement or your P&L. Therefore, we're gonna end up paying a bit more tax. That's it. But let's see how to calculate it. So some of the information here we already have. So let's see what we have. So we have the EBITDA, which should be up there. So just gonna bring the information below here. So let me see. Here we have the EBITDA. Okay. So then we're gonna have the interest expense, which is below here. It is this piece of information here. Depreciation, we don't have it. So I'm gonna just leave it as blank for now. We're gonna calculate it pretty soon, right? And then we have the geared taxable income. So it's gonna be the sum, right, of everything in here. And I'm just gonna make sure here I have the right number styling, which is comma 0. And here we have the sum. Okay, that's it. And we're gonna see this later on also. Okay, I don't want to get into it right now. But that's basically like carry forward loss. Okay, let's say we have a quarter where we just basically lose money. Okay, our cost is greater than our revenue, or our geared taxable income, this number here is a negative number. So essentially, because this number is negative, you should not pay tax, and you can carry forward this loss to be netted off whenever you have a profitable month, okay? But we're gonna say this in another video, not even today. And once we have this, so our net tax income is gonna be equal to this number here for now, okay? We're gonna have our tax rate and our geared tax liability to benefit. Okay, cool. So let's gonna get our tax rate. I'm gonna go here to the inputs. What I'm gonna do here, I'm gonna go below here. I'm gonna write depreciation and tax. We're gonna say that our tax rate in percent is gonna, let's say it's gonna be 20%. So I'm gonna just copy here. It's gonna be 20%, right? So I'm gonna name this to tax rate. Do we have already this? It's here. Okay, so I'm gonna get rid of this. So for some reason, by copy and paste stuff, so this was already here. So let me change it for that other cell. So we're gonna just click here, and it's gonna be this cell here. Cool. So that's done. Right? And what we're gonna do, we're gonna go below here. Where is our tax rate? Let me see here. Tax rate. So this is gonna be equal to tax rate. It's 20%. That's cool. And again, this is gray background with like light green color, just because it comes from external sheet, not this one here. So that's why we have this styling. And if you go here and here on my style, this is basically this one here. Okay, that's what it is. Cool. So let's see. Okay, but this is for the ungeared. So we were here. So this is for the geared one. So it's going to be tax rate 20. Oh, tax rate 20%, right? So I'm going to copy this one here and paste everything across. So everything's 0 because I have to copy these things in here. And I have to copy these things in here, right? So we have 59 million as EBITDA. We're basically getting 6.5 million as interest. Net on net, that's what we have. Let me just get rid of this formulas. What do we have? Okay, cool. Now just have better formatting. Okay, cool. So this is 0. We're just copying everything here. And our tax rate, as everything is a positive number here for now. So we're going to always be paying 20% out of our net tax income, right? So let me go here. It's going to be what? It's going to be equals to this for twice times this, and for 3 times. I'm going to copy. I'm going to paste everything in here. And I have to multiply by -1 because this is outflow of cash from the project, right? So I'm going to multiply by this by -1. Okay. So out of our 53 million net tax income, we're going to pay 10.6 million as tax, right? Yes, almost there. So what we have to do now, we have to calculate the depreciation schedules. Let's go for the depreciation. So depreciation, we have a calculation in here, and I might have to tweak this a little bit just to make it a bit easier, but we will see as we go along. So that's what you notice, right? So I copied this from another template that I had, like the infrastructure, not to waste time and like typing everything as we go along the series. But as I go, I realized that we may change a few things here and there, right? And as you gain experience in doing your financial modeling, you will know when to use what and how granular you want to be in your calculation, how flexible you're going to be in our calculation, right? So the purpose right now is just to have a simple financial model up and running. And once we finish it, the next step of the series just basically to add more complexity, or in other words, being more granular and more flexible in this model here. So let's see for depreciation. So what are we going to need for depreciation here, right? So we will need, I think we're going to need basically one thing. I think we just need to determine how many years we can depreciate the assets. And in this case here, we're going to use the straight line method. I have done a few videos. I'm going to say it again. Just watch them and see what the different methods are. And then you can compare one against the other. But for simplicity, now we're going to use only one method. But in later videos, when we add more flexibility, we're going to combine all of them together, and the user can choose which method to use, right? So I'm going to go back here to the inputs. I'm going to say here that the depreciation, let's say depreciation, it's going to be in years, and it's going to be 10 years, right? So I'm going to copy this. I'm going to paste here, and let's say 10 years. The assumption here is, the assumption here is that we are going to use a straight line depreciation. Let me put here, straight line, right? And there is no residual value. You can add the residual value, but we're going to use the residual value later on. And so all the capex that are going to have in this particular project is going to be depreciated in a 10 years timeline. That's what it is. And essentially, I can add, let's gonna add here depreciation rate. So depreciation rate, right? That's a percentage. And what's the depreciation rate? How much, because this is a straight line method, how much you're gonna be able to depreciate in any given year. So that's another thing too, per annual. So it's gonna be equals what? It's gonna be equals to 1 divided by 10. So we're gonna be able to depreciate 10% per year. That's what it is. So if you have 20 years here, we're going to depreciate 5%. And if you have 5 years here, we're going to have 20%. So again, that's going to really change depending which country you are. If you're in the US, they have the acceleration depreciation method, whatever the name is. I think it's MACRIS or whatever, it doesn't really matter. But if you're in other jurisdictions, that might change. You might have 5 years, 10 years, but to be really honest, as you do bigger projects, you're going to have to break down the depreciation to several different schedules because each asset has a different depreciation schedule and method that you can use. Okay, but we're going to assume for the sake of this model now, we're going to depreciate everything in a straight line during that 10 years, which gives us a 10% depreciation per year. That's important too, right? So I'm going to rename this here. I'm going to name this cell here for depreciation. Let's say it can be depreciation. This is going to be depreciation rate, depreciation rate. Okay, so we're going to go back in here. So depreciation percentage. So this is going to be depreciation rate, right? So it's 10%. But we need to make the translation now. So we need to copy from our debt, and I think we have to copy this piece of information here. We have to copy these things here to make sure that if you change the interval of our periods, then this information here is going to change also, right? So let me put like this. So we have 10. It's going to play around now and see if we did it correctly. So let's say we have 1 quarter per period. So that's 2.5%. That's correct, right? So that's pretty good. That looks good. Okay. So that's it. I don't think I'm going to need, let's see. I don't think I'm going to need this thing in here, but let's see. Let's analyze what we have in here. Okay, so again, we have another account for our depreciation. And what we're going to have our open balance. We're going to have our closing balance. And here we're going to have some additions and reductions, right? So to start with, we're going to add how much, we're going to add any sort of capex to the project, right? So this is pretty straightforward. So I think I'm going to start from here. So whatever capex we have in our project, we're going to add as a baseline for our depreciation, right? So this is a negative number. So this is the capex, right? But this is a negative number because in this particular case here, the cash outflow is going out of the project. But for the depreciation account, I want to have this number here as a positive, okay? So I'm going to multiply this by -1 and I'm going to copy everything across, right? And to start with, in the first day of the project, there is basically no depreciation. So I'm going to make this equals to this row in here, okay, which is the previous period, the closing balance of the previous period. So because this is not really used in our calculations, I just left this as a gray, okay, gray background, because then the user understands that there's something in here, okay. And if you want to check if this cell has been used for anything, you can press Alt and P in Excel, okay, but here in Mac, you cannot do it. You have to do it. You have to come here to formulas, and then you have trace. No, not this one. Trace dependence. Yeah, there we go. So there we have it. So in Excel, it's Alt M D, and to get rid of this cell, you can press Alt M A A, or just come here and click in here. Okay. Again, I'm using Mac. I don't recommend using Mac at all when you're doing financial modeling, just because of the shortcuts. You don't have that many options. There are few, or actually there are a lot of shortcuts that are not able to use on Mac. But I just use here because it's easier for me right now. But professionally, I don't use Mac. I use Excel. It's much better. Sorry, I use Windows computer, PC. Much better than Excel. Let me get it to you now. Okay, cool. So we have our balance. I'm going to copy and paste everything across here. Everything's 0, but the thing is it's just moving around. We have our additions. We're going to have our depreciation. That's exactly what we want to calculate. We have write-offs. We're going to explain this later. Not sure if we're going to calculate it today. But the thing is that once we calculate everything, we're going to have the sum. We're going to sum everything and get back to our closing balance. And as we move along here, sorry, I don't. Let me, as we move along here, oops, sorry, format. We are gonna keep adding depreciation, right? We're gonna keep adding value to our depreciation schedule until we reach the 30 million capex for this particular project. And from here, we have to start depreciating the asset, right? So let's see how to do it. Let me see. So now I have to calculate our depreciation in a straight line. So essentially what that is, let me see how to, let's think through, right? So we have to depreciate 2.5% as long as we are on operation. So this should be true. The flag here should be true, this flag here, right? So that's the first thing. and we should add maximum to 100%. That's how much we're depreciating, right? So that's the, let me think how to do this here. So we have to have a counter to, right? So let me see. Let me just think how to do it. So we have the depreciation here. Depreciation, right? That's going to give us 10 years. So let me, if I multiply this by this, right? So I'm going to multiply this by this. So we have, no, that has to be the other way around now. So if you do this thing here, oops. Okay, if you do this thing here now we have 40 periods, right? So that's what it is. So the number of periods. Okay, depreciation. So let me just, don't be lazy. I'm just gonna copy this thing here. These two here should be green, right? Should be external, right? And this one here should be a comma 0 or comma 0. Okay, so this is straight depreciation. Okay, so let me see. I'm just formatting stuff for depreciation periods. Okay, so it's going to be 40, and that's fine. So let's see what we're going to do. So as long as we are in the operation period and its depreciation period is lower than the 40, we should multiply 2.5 by this, right? 2.5% by our open balance in depreciation, right? So that's what should be. So let me see, it's going to be what? If, let's see if it's going to work. If what? If, let's go up. So we have if this here is equals or less than this number here, F4, then it's going to be what? This number here, 4 times the open balance, this one here. Otherwise, it's going to be 0, right? So let me see. Why this did, let's copy and paste everything across. Let's see what we have here. Okay, so we have, right? So, but this is wrong. Why is this wrong? Because I also have to multiply by this flag here, F4 twice, right? Let me see now. Okay, 30 million here, so this is correct. So 30 million, right? So always check to make sure the numbers match. It should be 30 million, but it should be a negative number. So I'm going to multiply by -1. Copy and paste everything across. We have negative 30 million. Let's see where we are ending up with this. For example, I'm just moving to the right, to press the arrow to the right. In Excel, in PC, there's a much easier way to do it. In PC, there's a shortcut that you can do it faster. In Mac, there is also, but I just can't remember. Anyway, let's gonna check if we are on period 40 here. Yes, that's the transition between period 40 and 41. So this is correct in here. Sorry, this is correct in here. And also another sign that this is correct is because we have the 30 million in here, which is equal to this number in here, right? So now we're gonna say that this is equals to this thing here. And we're gonna copy and paste, and I'm gonna copy and paste across. It didn't match. What's going on here? Hold on a second. I think there's a circularity, right? Let's see. Yes, there's some circularity going on here. I see. Let's see where the circularity is. I see. So what are you going to do? Okay, so we don't need actually, what we have to do, we can bring the capex. We can bring the, I know what to do. So we're gonna do periods 2.5%. Let me just copy this thing in here. I'm gonna say USD. So this is depreciation. Let me press depreciation value. Okay, value. So that should be okay. So I got it. So essentially, what's going on here? There is a circularity in the model. Okay, that is when I reduce here by 250. The number here, we're not circularity. Sorry, we're multiplying the 2.5% by the open balance, and that's wrong. Okay, what should be multiplying this number for is by the capex. So by how much are we depreciating our asset, right? That's going to be this number here times the 30 million in here. Okay, so it should be like this number in here, right? That's $750,000. Let me model it. Okay, so we're gonna model it correctly, and this is an in-sheet calculation. And now what we're gonna do, we're gonna get rid of this thing here because we don't need to multiply this anymore. And then I'm gonna multiply with this number here, F4. Okay, I'm gonna copy and paste across. We have the 30 million. Here we have negative 30 million, which is correct, and here we have 30 million. That's correct. So you see, like I have to think through this as I go through the model. Like I know, but I just sometimes I just do the things wrong, and then you have to always keep checking what you're doing, okay? Because you're gonna do a few mistakes as you go along, and you need just to pay attention to what you're doing, right? So let's gonna double check here. Yeah, we already did it, but it should be, everything should be correct, right? So this is period 4. I'm gonna see, yeah, that's period 4. So everything is correct in here. Next, so we have already our depreciation schedules, and I'm gonna leave this for later on. Okay, we don't need to have this now, and we can do this later. But essentially, let me explain what this is, right? So let's do it now. It doesn't really matter. Okay, so what this is, let's say we have not 30 years project as we have here now, but let's say we have only, let's say we have a 10 years project, okay? And let's say that we will depreciate our assets in 15 years, okay? That's not gonna happen, okay, here right now, but we understand why this we need to take care of. But let's say we still have to depreciate assets, okay? Let's make this assumption. We still have to depreciate assets after or at the year that we're going to stop running the project, okay? When we're going to retire the project. So what's going to happen, as you can see here, we're not going to depreciate everything. There's still $10 million, or 1/3 of the value or the depreciation value of our assets, okay? The book value should be depreciated, okay? And that's what the write-off is used for. We're gonna check here, okay, if at the end of the lifetime of this project, okay, we still not have depreciated everything. We're gonna do it right there, okay? How to do it? Essentially, or what we have to do, we have just to get the sum of these numbers in here, and we're gonna just depreciate it, but it has to be a negative number, right? So that's what it is. You see, that's exactly what it is, nothing more. So what I did, I'm gonna check if this column here is on the last period of the asset lifetime. We're gonna just depreciate everything by using this formula in here. What we need to do now, we need to only do this if, right? So if this column here is on the last period. So how do you do this? If what? Let me put a comma here. I'm gonna just do here 0, 0. So I'm just already checking if it's false. What is the condition? Which condition should be true now? Let's see. If this date here, I'm gonna press F4 twice, is equals to this date here, right? So this is our end of the lifetime. I'm gonna press F4 here. So if this is true, then you should return, oops, sorry, I screw up here. So if this is true, sorry, let me do it again. 5, I'm gonna press F4, I'm gonna anchor here. So, okay, so if this is true, oh gosh, my gosh, okay, that's why Excel in PC is much better. Cool. If this formula here, if this condition is true, we're gonna do this calculation here, otherwise it's gonna return 0. And it should be true here. So now I'm gonna just copy and paste everything across. And as you can see here, when you add these two values together, then we have the 30 million, which is correct, right? So we're depreciating everything the very last year. And if I change here now for 10 years, so if we make these things equals, we should have 0 in here. And of course, if we increase the periods of here to 30 years, that the write-off should also be 0, okay? So we're making a huge simplification here in the model too, okay? What most likely is gonna happen is that throughout the lifetime of the project, you have to revamp or have to buy new assets. So we have to have those additions in here, okay? So let's say we have 30 years operation, but in year 25, you have to buy a few more new models, okay, for your PV panel or a new inverter or whatever that is. And because you just bought it on year 25 and it has a 10 years depreciation life, and you're just close, like you just have 5 more years of operations, your new assets is gonna last for 10 years. So what's gonna happen is that still your assets gonna be fully depreciated once you have to retire the unit. So we have to account for these situations, right? So here we're not account for it, okay? We only assume that we're gonna buy assets in the beginning of the construction period and nothing more during the next 30 years. That's very unlikely, right? So this is something that we have to work, and we're gonna do it in a later version of the model or in later videos, okay? But as it is right now, it's working pretty well. So let's go up here. We're gonna go now and fill out the depreciation, right? So we're gonna say that this is equals to our depreciation that is being calculated in here. Okay, so there we go. I'm gonna just leave this blank. I'm gonna copy and paste everything across. I'm gonna just copy the formulas. Yeah, and I also have to leave this as blank. Okay, cool. So I think that's basically it. So we have our taxable income in here. We're gonna take care of this before later on. And as you can see here, everything's a negative number, right? So in principle, we have negative taxable income, so we don't pay income. So as you calculate here, basically we have a positive number, and positive number means a tax benefit, okay? So that's wrong. We're not gonna deal with this right now. We're gonna deal with this later. And I'm just gonna tweak a little bit the model so that these numbers here, they get positive, okay? Because I don't wanna fix this now, okay? So our project, our numbers, our inputs here, they are quite off, I would say, okay? So I'm gonna make a few changes in here so that these numbers in here, they get positive. So let me do it right now. I think I know what to do. I'm gonna put here 45,000, okay? I'm gonna put here, let's see, that's 20 here. I'm gonna reduce, let me see, I'm gonna 0. We can leave this for now. Okay, we still have a bit more. And I'm gonna put 80 here. Okay, let me see what we have now. Okay, now we're paying, okay, now we have positive net tax income, and then we are paying tax. Okay, so that's fine. So just make a few tweaks in the model, and that's working. So we calculate our tax liability because this is a negative number. And again, that's why it's important to use parentheses or brackets. I don't know what the right word is in English, but whatever that is, just always use the format of our numbers as it is in here, because it's clear that this is a negative number. It's much easier to see, and then you can refer back to our labeling here. And as you can see here, I put the label as a liability or money going out of the project with the same brackets or parentheses, okay? So it's another reason why you should use this format in here, right? So what I'm gonna do, I'm gonna copy this number here and paste it or link it in our cell above here, okay? So that's where we go. Alt ES, formula F, enter. So that's what we have in here. I'm gonna make it white and I'm gonna copy it across. What's going on here? I know what's going on. Okay, I did it wrong. Let's simplify. I'm gonna say equals to the tax. There we go. Cool. Now I copy and paste across, and there we go. So we're paying 15 million, and our cash flow available for serving the debt is $800,000 in the first quarter, right? That's a quarter. So this is the cash flow we're gonna have available to pay our debt. That's exactly what CFADS is. That's a very important metric for project finance, for projects based on project finance. Then we're gonna serve our debt, meaning we're gonna repay our interest and principal. That's the total value. And what is left, or the sum of this number here plus this number here, is going to be the cash available. Sorry, let me just, so annoying. Why every time there's this border is all over the place? I don't need it. So let me copy and paste everything like this. Okay, now we have in a much better way. So, okay, so this is the cash flow available to equity investors, okay, during the operation of the project. So that's what it is. And to finalize the video, now we're going to come up with the DSCR calculation. So DSCR stands for debt service coverage ratio, okay? And what that is essentially a metric that measures how much of your cash flow available to serve the debt is greater than the total debt repayment. It's pretty simple. It's going to, let me do here, it's going to be equals to what? This number here divided by this number here, multiplied by -1, because everything should be positive. So essentially what it says you have 2.4 times more cash available to serve your debt than your debt requirements. That's what it is, straightforward. You just have to do a few tweaks in here because we can't divide things by 0, right? So that's the only thing you have to take care of. So let's see how to do it. So if what? Let me think. We can use, let me see, if what? If this is equals to 0, right? Then we're going to return 0 because we pay, let's say this. If this is equals to 0, then it's 0 because if we don't pay any debt, means that we repaid everything. So we don't need to check our DSCR. So if this is 0, then 0. Otherwise, we're going to do what? Otherwise, we're going to get this divided by this multiplied by -1. Let me see if we're going to be able to address everything here. But actually, if this, I don't want it to return 0. I want this to return empty. And I'll tell you why. Let's see if everything... Okay, now it should be work because here I want to get the minimum value. And I want to come in here. Okay, 2.39 is pretty high. Okay, so that's done. Okay, so this is the formula again, right? So if 0, I want to return empty, otherwise do the calculation that we need. And I calculate the minimum value here during the project lifetime. And usually if you're going to do a project finance, most likely they're going to ask for you to have the minimum value to be between 1.2, 1.3. That should be enough, again, it depends on which country we're talking about, right? So if you're doing a project in Switzerland, or if you're doing a project somewhere in Africa, Latin America, Southeast Asia, so that's going really to change. Of course, depends on the financial strength of the project, basically, and the company. Okay, so that's basically it. It's pretty optimistic, this project right now. 2.4 is quite high, but again, that doesn't really matter. The numbers doesn't really matter. What really matters is whether the structure that we're building is good enough for this. Okay, so that's it for today, folks. I hope you have enjoyed the video. Please subscribe to the channel and give a thumbs up if you liked and learned from today's video. See you later. Bye.